Welcome, everybody, to the Tuesday edition of the Not Your Average Investor Show. Today, we are answering a question that we keep hearing is on everybody's minds. And that is, if rates are going to come down in the near future, should I buy now and lock in that price and then like bank on appreciation, refinance later? Or do I wait, take maybe a higher price, maybe a lower rate? Who knows what's going to happen? So I challenge old GC over here to come up with some numbers that we can really put to this thing that we can test. I'm your host, Pablo Gonzalez, live from the Casa Pablo Estudio with my friend GC over here, who's always with me. And I call him that because he's a great co-host, because he generates cash flow, because he genius concepts. It's one of these genius concepts you're always coming up with. And because his name is Gregg Cohen. Say hello, Greg.
Genius concepts one was hard for you to get out, right? You're not totally sure about that one.
It's because I started beating myself up over it, starting the wrong way around. I called you a great co-host first.
Well, hello, everybody. Great to be with you.
It is great to be with you. You know, we don't normally start 2 minutes late, but it's worth the wait.
Special.
It's worth the wait today. It's worth the wait today. And you know what else is worth the wait? This Not Your Average Investor Summit that we've been putting over together for over a year, much anticipated. We were originally going to sell only 50 seats. We were thinking, but we're already way over that, GC. You were just giving me an update?
We are. We're up to, I believe, right around 65 tickets sold.
Ooh.
Guys, the venues only hold 100.
Yeah.
The venues only hold 100. So we want to encourage all of you to go to jwbsummit.com and register now. Tickets are $139 after January 14th. But for all of you, all of our Not Your Average Investor community, up until January 14th, it's only going to cost $99. And there's a special promo code. I think it's NYAIS99.
Let us know, Cody. Cody, help us out. Help us
It's
out.
either NYAI99 or NYAIS99. Try them both. Have a ball.
Yeah.
We can't wait to see you.
But you go to JWB Summit. Summit is 2 M's, 1 T. I've made that mistake before. jwbsummit.com. Sign up for the summit. We have really not pushed this to anybody except for just our community on the show and a tiny little blurb on newsletter. And we are already more than 2/3 sold out. So we expect this thing to fill up the moment that we announce it to the outside world. So we want to see our favorite people there, the cool club. We want it in the house. My parents just said they're coming.
Woo!
Yeah.
Mine too, by the way.
Your parents are coming? Let's go. Let's go. It's going to be awesome. Can't wait to have you. 2 days of connection with this community, real estate education, and just a behind the scenes look into what I think is a truly, truly extraordinary thing, which is the building of a city before, when you know that there's an after right around the corner. I think that's so compelling to be able to see the before, knowing that there's an after, and being able to like tell the future. I think it's going to be awesome. I can't wait, GC.
You and me both.
You and me both. jwbsummit.com. Meet us there. And if you meet us there, you get to meet the folks that joined in on what, GC?
The roll call, baby.
Baby! We got our leadoff hitter kicking us off today.
John Henning.
John
rightful spot.
In his rightful spot. We've got the mystery man.
Mr. Denny Davies.
Mr. Denny Davis. We got the MVP. I think you've heard of him.
Mr. Lee Bishop.
Mr. Lee Bishop. We got Lita Song, beautiful investor from Minnesota.
Absolutely.
The Minnesota community is starting to get strong.
I think so. There were 2 or 3 folks last time from Minnesota.
Last time.
We got pretty much the whole state on that.
I mean, it's Minnesota. We got Chris Lee from Fernandina Beach with a hello all. We got the patron Santorios of the Not Your Average Investor Show community.
Michael Santorios.
We got Jeff. Petty John is back. Jeff, you're becoming a regular out here, man. I'm gonna have to think of a nickname for you, buddy.
I think I saw Jeff's ticket order come through. I could be wrong, Jeff. I hope that you're coming.
Let us know in the chat if you're coming. We got the Maven from the mountains of Denver,
Leslie Wilson.
Leslie Wilson. I know she's coming. We got Chris Gonzaga from
the illustrious Hudson
Valley. We got our favorite name to pronounce, Aaron O'Neill. Into the lights. We got our regulars, Gary and Rosalind Riley from Marietta, California. We regard you. I know that they're coming. I can't wait to meet them. We got Big Papa in the house. We love it when he calls him Big Papa.
You know he's coming.
Big Daddy.
Yeah. Funny thing, by the way. Not funny, but really, really cool thing.
Yeah.
So when we first got started with JWB, well, this was before we even knew what we were doing with JWB. My business partner, Alex, and I were reaching out to the people that we love the most and said, hey, who can help? And so my dad arranged a meeting with his friend, whose name is Frank. And Frank is a really successful developer, and he was kind enough to sit down with us 18 years ago and take us out to lunch and give us some words of wisdom. And you know who's coming alongside my dad?
Friend Frank.
My friend Frank. His friend Frank.
His friend.
Friend.
Our friend Frank. Can I be frank with you, Greg? I can't wait to meet Frank.
He is quite a friendly friend. Frank is going to be awesome. So yeah, so he's coming up. He hasn't seen JWB in 18 years. So he's coming on up. So we're excited.
What's going to think? You think he's going to be like, oh yeah, this is what I saw coming?
You know, my dad, he talks a lot about JWB.
Yeah.
So,
all right,
so he knows a little bit about JWB, but he hasn't come up and seen everything that we've been doing.
Exciting, man. I'm pumped too. I'm frankly excited. To be honest, we got the better Greg in the house.
Gregg Stone.
Greg Stone. We got a Not Your Average Guest checking in. If you check in with your text, I don't know who you are, so you got to tell me your name because you just populate as Not Your Average Guest from Maryland. Welcome. We got Vincent Barbarite. Barbarita?
Vincent Barbarite.
Barbarite.
Yeah.
Is that Barber right or Barber wrong? I like it.
We're on a roll today.
From Long Island. I'm just spitting stuff out here. Who else we got? Steven. This is a tough one. Chmielewski.
Oh, well done.
Yeah, Chmielewski. Steven,
Well done.
let me know how I did.
Welcome.
Providence, Rhode Island.
New name.
Welcome to the show. Welcome to the party. Good to have you. Who else? We got Chris Lee. Are you already? Oh,
Billy Gray.
From the somniferous mountains of Colorado. Billy, I don't appreciate you challenging me with pronunciations with words such as somniferous.
I feel like that was in my sixth grader's homework last night. I had to define somniferous. So there we go.
Well, your sixth grader's really smart in her defense. All right. So we got Billy Shields with Buenas tardes, amigos.
Welcome, Bill.
Good to have you, Bill. We got Allie King, teammate Allie King.
Love that.
House,
Love the JWB presence.
Love to have the teammates in the house. I didn't know there was a code. I have to get my ticket though, and looking forward to it. All right, glad to see that. We got Right Along Raj. I know he's coming back.
Absolutely.
We got the patriarch and the matriarch of the first family of the Not Your Average Investor Show, Ken and Carolyn Moline. We salute you. Who else? We got Marty Quinn in the house from Golden, Colorado. We're getting a Colorado contingency out there.
What a great roll call we have today.
We got a good morning from Washington State in the house because you checked in with your text, so I'm not sure who you are. Let me know. We got Mike Foster in the house. He's back.
Mike Foster with his incredible insights. 12 plus years of being a JWB client.
Love it. He says, will the 2 happy hours be at the JWB office?
They will not. We have some amazing festivities at the JWB office, but we're also going off campus too. And we're going to 2 separate happy hours and wonderful dining establishments here in downtown Jacksonville.
We got Joni from Destin, Florida. Joni, new name.
New name. All right.
Good to have you, Joni. I'm a big fan of Destin. Beautiful, beautiful place. We got the fairy godmother of the Not Your Average Investor Show community.
Miss Jen Fills.
Miss Jen Fills, and always spreading the joy out there. Love to have her in the house. He said, all right, I think I pronounced it correctly. And David Blatter's in the house. David, we haven't seen you in a while. Laura Colby is checking in from Washington State. Laura, thank you. Thank you. Happy to have you. Misty Johnson and her husband Joy were recently on the
top 10 list.
Top 10, number 9.
Number 9. She's working on that ranking. She wants number 5 this year, or maybe number 1.
We got the Jeopardy Queen, Margaret Smith from Sarasota, Florida.
Right, the Jeopardy Queen. Very good.
Nicholas Pardo from Jacksonville, first time tuning in. Nick.
All right.
Nick, you got to come to the summit if you're here.
100%.
Yeah, Nicholas, let us know where in Jacksonville you live, man. We are right now Atlantic Beach adjacent at my place.
Yes, we are.
That's what I call it.
Mm-hmm.
What else we got in here? All right, man. Full on work call. Celia Carmo from Virginia. A bunch of new names. GC, people must be interested in this topic. Lori Huff is in town from Charleston, South Carolina. And let's just jump back in, man.
Let's do it, man.
Yeah. By the way, we are here in my home office because there's like a tornado. Why? I don't read the news. What happened?
Really? You didn't know when you were texting yesterday? You didn't know?
I literally said, guys, what is happening? And you guys laughed at me.
There's a potential for some severe storms here in Jacksonville.
Okay, got it.
So we're working remote here at JWB, just an abundance of caution. If you look outside right now, there's 0 rain and really 0 wind as I was coming over to Pablo's place. But, we have an organization here now where we're, responsible for hundreds, if not thousands of families. And so we're going to go the safe route. We work remotely here. And then if there should be any storm related concerns or damages with any of your properties, you guys have been through this more and more with JWB and with the show. We will 100% keep you up to speed with any of that. However, this is nothing like we have seen in the past, at least the expectations. So we'll see how it goes.
We'll see how it goes. That way we're being safe. We're here. Estudio Pablo.
Mm-hmm.
And GC, we got a whole bunch of people showing up, man. I think we have been talking about this for a long time. Mm-hmm. We have been talking about this idea that we know that right now prices seem high and interest rates are high. And we know that when interest rates, we have a prolonged period of interest rates being high, we know that people tend to be wary of investing in real estate. But we also have talked a lot about this effect that when interest rates drop, prices tend to shoot up. And therefore, the question to be asked is, buy now and lock in these prices, knowing everything that's going on with downtown and all these other things that we're going to talk about at the summit, or do we wait? Right? And I think we did a show last week which nuanced, right? Like, what was the title of that one?
It was like whatever today's title was, adjacent to it.
Yeah,
it was close.
It was the opposite,
Yeah.
right? Like it was the opposite of it. This is actually going to look at the numbers in the future, right? Like what's going to happen. So let's get into it, GC. Before we get into that, how'd I do there? Anything that you want to clarify?
Well, I think the whole show is about clarifying and refining the point. So I think that was a great start, and we'll let the numbers kind of dictate the story a little bit more.
Fair. You have any advice to start?
Well, I do have some advice. Funny you should mention that.
All right.
You know, our wonderful legal team tells me I should give this advice. Anytime that we are talking about real numbers that I'm sharing with you, guys, do your own due diligence. This show is meant to be educational. When we talk about returns on investment, these things are estimated. They are not guaranteed. And like anytime you're about to spend a lot of money doing something, anytime you buy an investment in property, make sure you do your own due diligence, even beyond attending this wonderful program.
Got it. All right, let's get into it, buddy. What do you got first for us here?
Well, I first wanted to give everybody kind of a lay of the land when it comes to long-term interest rates. The most often quoted long-term interest rate is the 30-year fixed rate mortgage interest rate. And so that's what you see here on this slide here. It actually gives the 30-year rate and the 15-year rate. But if you can see there in the top left, right now, our 30-year average interest rates, according to Freddie Mac, are at 6.6%, give or take. And if you go back to last October, rates were close to 8%. It was actually it was about 1.2% higher just a few months ago. So overall, we have seen interest rates come down, which has been a really welcome sign for all aspects of the economy and for investors specifically. But one thing we have not seen is that the Fed Reserve has not lowered the Fed funds rate. And so there's a lot of questions right now about how could long-term interest rates come down over a percent without the Fed dropping the Fed funds rate. And so this has been a topic of conversation, and that's largely what we talked about on the show last time. So if you'd like to get a little bit more information on that, go back to the last show that we did. But overall, this is showing that it's an indirect relationship between what the Fed does and the Fed funds rate, and then what our long-term interest rates are. But there's more insight to be gained there as to how that's happening, because we can use this information to better understand and potentially predict what is going to happen with interest rates in the future.
Let's do some predicting, shall we? Yeah.
So this really scary graph that I'm putting up here is really powerful. Okay, and I'm going to take all these squiggly lines. This looks like an EKG or whatever, right?
Looks like an EKG.
All right, there we go. So I'm gonna make it less scary here. What this is looking at is the relationship that drives how our long-term interest rates are formed. And really, what's happening here is investors actually choose to invest on the other side of our mortgage-backed our mortgages. It's called a mortgage-backed security. So there's some investor on the other side who's saying, yeah, I want to earn a 6.6% return when I invest in mortgage-backed securities. And overall, investors look to other investment opportunities, and they say, well, listen, I could do this and maybe earn more return, but maybe take on a little bit more risk. Or I could do this and maybe make less of a return and take less risk. And so mortgages are actually pegged most closely to the 10-year treasury. And the 10-year treasury is, of course, from the federal government, which, we can print as much money as we want. So that is viewed as a risk-free investment. So if you're an investor out there and you're saying, well, listen, I might be able to earn a return from a 10-year treasury, you might say, well, if I'm going to invest in mortgage-backed securities, I'm going to need to earn a higher return on that investment.
You got to pay me for my risk.
You got to pay you for your risk.
You got to pay me for the risk.
So what this slide is showing is that over time, that spread has been about 1.7%. And I'm not really good with numbers, with colors, Pablo.
You are
What's
nuts.
what's the one at the very bottom? What's the colors? Like
It's
gray?
It's gray. The
All right.
flatter one is gray. Then we got a light blue one right above it that just kind of like goes up above it and slightly dips under it every once in a while, and now has like dipped way under it. And then there is a dark blue one that goes up and down, a spread above it, like a couple. And I'm just talking to our listeners on the podcast right now, and then has like spiked up there on the back end.
And this is like 10 years from 2010 to 2020.
Yeah.
So it's not up to speed. But what this should show you is that historically, that spread between the 10-year treasury and the average the average interest rate for long-term mortgages is about 1.7%.
Okay.
And that's historically what it is. So now we got to ask ourselves, well, what's that spread right now?
Yeah.
Okay. So let's go over to the next slide here. And this is our current 10-year treasury yield. If you want to go and invest in 10-year 10-year treasuries right now,
Than it sounds.
you'll earn, call it 4%. Okay. So if we know that 10-year treasuries at 4%, and the historical spread between that and mortgage-backed securities has been 1.7%, what would you expect long-term interest rates to be?
If the 10-year, can you say that again?
Yeah, so we know that to formulate the average 30-year fixed rate mortgage interest rate, you're basically taking the 10-year treasury, and then you typically have a spread, a premium that investors require.
Yeah.
And so we know that the 10-year treasury right now is 4%. We know that historically that spread has been 1.7%.
Got it. Got it. So
What
I would
should-
expect the interest rate to be around 5.7%.
Exactly.
Yeah.
Exactly. But what is our interest rates right now?
I just got a interest rate at like 6.3 is what I got for my personal property. I know that JWB is offering right now with the incentive and with the buy down somewhere around 5.7, right?
We are.
Yeah.
And I'm really glad you mentioned that.
Yeah.
Let's go a little bit more macro though, right?
All right.
Let's not go specifically for you, and let's not go specifically for JWB, because we're trying to formulate basically how the interest rates are, if they're above, if that spread is higher than what it should be, or lower.
Okay, well, I'm going to guess based on what the patron Santorius put in the chat of the spread currently being 2.6, that the interest rate right now is 6.6.
Exactly. Very good. Very good.
I figured it out all by myself with Michael telling me the answer.
And it was on the first slide that we went through as well.
That's true. There's a lot going on here, Greg. I'm managing the community. I'm trying to co-host here.
You do a fantastic job.
I appreciate it. And just for the record, if you're listening to this thing on the podcast, if you go to our YouTube channel, you can see all these spreadsheets that we're talking about.
Yeah. So long story long here, the spread between the 10-year treasury and what our actual long-term interest rates are is much higher than historically it has been. And, if you go back to October, when interest rates were closer to 8% overall, the spread was even wider, right? So what this should represent for all of us as investors is, if historically that spread has been 1.7%, and right now it's about 2.6%, even if the Fed does not lower the Fed funds rate anymore, there is an opportunity for interest rates to come down even further.
Coming down.
Right. And when the Fed does lower interest rates, well, if it would stay consistent with that 1.7% spread, well, then you have an opportunity for interest rates to come even lower than that.
Got it.
So all this being said is we have a lot of potential movement. Now that the economy and the investment world and the Fed has signaled that the end of rate hikes is here, we have a lot of downward momentum and potential for interest rates to come down.
So correct me if I'm wrong, GC, but this sounds like this is the most certain that you have sounded about interest rates coming down in the near future in a long time.
I'm still going to pause a little bit because I am very confident that interest rates are going to come down at some time, at some point.
Yeah.
But there's still so many variables. There's so many variables out there with the world and some of the chaos that we have in other countries and other things that I don't think it's just going to be like a slide like this. I would imagine it's going to be sort of a bumpy road. But yeah, I do see interest rates coming down at some point here.
Okay. All right, cool. All right. Next slide.
Yeah. And then this was just showing what that differential is, that spread is today. So it's not 1.7 today. If you look on this slide here, it's showing that it is somewhere around 2.75 is what the spread is. And the dates on this are a little bit different than the dates that I pulled the other data. So that's the only difference between 2.6 and 2.75. You kind of can see what's happening here. It used to be 1.5 or 1.7. Ballooned up to over 3 as that spread, back down to 2.7-ish.
Yeah.
And we are hoping and expecting that that spread will continue to compress.
Yeah. So what I'm hearing right now is, and what I assume is the reason that we have over 70 people for this call right now, which glad to have you, good to have you here, is if I have been telling myself, I really want to wait and invest in real estate, but I want to wait till the interest rates come down, I'm really right now thinking, okay, interest rates are going to go down. Should I really continue to wait, or should I get in on this thing? Is kind of like what I'm hearing. And they're right to be asking themselves that question, because it seems like we've never been closer to that horizon of falling interest rates.
Exactly.
Okay. So fair question. Let's answer.
Well, so what we have done on the show, and it's been earlier than I think I've read in most places, is talking about the impact once these interest rates do come down, what happens to home prices. So us and Barbara Corcoran, our favorite shark on Shark Tank, have been talking about how housing prices generally go up significantly when interest rates go down. And so beyond what our favorite shark here, Barbara, has said in the media, I went and I put some data behind it. And I went back and I looked at different points in time when interest rates have actually dropped significantly. I looked back to see when interest rates dropped more than 1%. Now, how much did they just drop for us just in the last few months?
Like 0.8,
1.2%, right? More than 1%. Oh, really good, man. I'm firing everything at you today. So
I'm having a hard time between my own personal home purchase and like everything going on in the show. I'm a little overwhelmed.
Good. I'm going to keep firing them at you.
Yeah, please do. Please do. I really need that.
So the data I'm going to show you is when interest rates dropped at least 1% on average from one year to the next.
Yeah.
We have just seen interest rates drop in the last few months, 1.2%. And so there's a good sign that in 2024, that is going to be the reality compared to what average interest rates were going to be in 2023.
Got it.
And here's how the data shakes out. Okay, so from 1982 to 1983, we saw the average interest rates drop 2.8%. And the following year, home prices appreciated 6% on average. And this is Jacksonville data as far as home price appreciation data. So 1982, 1983, 6% in appreciation the following year. And then so on and so forth. 84 to 85, average interest rates dropped 1.5%. You saw 4.7% home price appreciation the following year. 85 to 86, average interest rates dropped 2.2%. You saw 4.4% home price appreciation the following year. 92 to 93, you saw a 1.1% drop, and you still saw 2.5% home price appreciation the following year. 2000 to 2001, you saw average interest rates drop 1.1%, and you saw home prices skyrocket the next year.
Yeah.
Appreciation came in at 8.9% in Jacksonville that following year after the interest rates dropped. So you're seeing 1, 2, 3, 4, 5 straight examples of interest rates dropping and significant home price appreciation the following year. And there's 2008 and 2009, Pablo. Interest rates dropped on average 1%. What happened with home prices?
It was the housing crisis, and home prices bottom fell out and dropped. Dropped 9.3%.
There you go. There you go. What's different about that time period, 2008 and 2009, versus every other time period, is that real estate caused the recession. Real estate was the impetus that the Fed had to take action, and indirectly interest rates dropped like they did. Every other example, interest rates dropped and real estate appreciated that following year, which is the same as what we're seeing here, 2023 to 2024. Real estate certainly is not causing interest rates to drop.
And if you've been following along with the show, right, like what Gregg has realized is that if we're going to compare this thing to another time like that is comparable to economic conditions to a certain extent, it is the 80s, that early 80s period where we went through high inflation for a long time in the 70s. They had to raise interest rates in order to temper inflation. Once inflation got tempered, now they started dropping the interest rates, and we see this behavior: 6% appreciation, 4.7% appreciation, 4.4% appreciation. That was the 80s. That was a similar condition, because right now we find ourselves on the back end of very high inflation, interest rates raised historically for a really long time, things tapered off, and now we're starting to see interest rates come back down. Inflation seems to be under control right now, at least for now, and that's what's happening, right? And I think to put like a human element to this thing is kind of what we have seen most recently, right? Like I think that 2000 to 2001 where it skyrocketed, I'm pretty sure that was post September 11th, right? Like they dropped interest rates at that point to like preserve the crisis because of Wall Street and everything that was going on. Big jump. I think we all kind of, if you're us or older, you lived through that. You saw a buying frenzy happening in homes, people snatching homes, competition on the street nonstop. We saw a similar buying frenzy post COVID where there was just like every home had a competing offer. Prices were going through the roof. It was just kind of like a piranha fest. And it even got to the point where JWB had to limit the inventory that they would sell. You never ran out of inventory like other folks did because you're better planners and you've built this turnkey vertically integrated model. But like it got to the point where like, hey, you can only buy one house at a time. You can't buy bundles. If you're on a certain financial plan, we got to talk about that, right? So that's just a very natural thing. When the deal is the debt, which is what we've just went through in 2020, 2021, those times, people are very, very fast to act because there's just like pent up demand. So prices go up rapidly is what we have experienced in the near past.
Exactly.
Right. So now let's talk about it. So it begs the question, right? So does that mean, all right, cool, man, I can't wait for these interest rates to drop for me to get in? Or, hey, maybe I should get in now, get that home price appreciation that we know is going to happen once they drop, and then refinance later.
There you go.
And that was a challenge I put on Old Genius Concepts over here.
So there we go. So let's talk about this first scenario. Let's say number one, you buy a property today.
Real quick, GC, before we get into this, Lead a Song has a specific question. First time rent, does management take it or take a percentage of the fee?
So first time rent, whenever we're collecting rent for you, Lita, we collect 10% as our management fee. So the first month that we collect the rent for you, we hold back 10% as our management fee.
Okay, there you go. All right, so now let's get into the scenario. Oh, what did I just do here? All right, you're good though. Why don't you explain what you
So first scenario, let's say that we buy a property today for $240,000. I chose $240,000 because that's an average purchase price for a JWB property. And let's assume that over the next year, interest rates drop 1%. And because of these interest rate drops, home prices either increase 2.5%, or 5.3%, or 8.9%. Why did I choose those numbers, Pablo?
Because those were the numbers that we just saw on the last chart about averaged out there.
Yeah, exactly. 2.5% was the lowest that home prices have appreciated in Jacksonville the following year after a 1% decrease of interest rates. 5.3% was the average increase of home price appreciation the following year, taking out the Great Recession. And then 8.9 was the top level of price appreciation in 2001.
Yep.
Exactly.
Got it. So I see what you came up here, GC. So if prices went up by 2.5% over the next year, that means that for this $240,000 home, you see home price appreciation, you see your net worth grow by $6,000. You minus the refinancing costs of $3,600. Is that refinancing to go down to like 1% down? Okay.
Well, yeah, whatever the lower interest rate is, so that in essence, that 1% drop, that would be the cost for you to refinance your loan to get now down to that lower interest rate.
Got it. So then your net profit would be $2,400 for having acted now. Seems like a good deal.
Yeah. If you believe that home prices are going to go up from 1 year to the next, even if they only go up 2.5%, then this would show you that you would still earn $2,400 in profits, even if you had to spend some money to refinance down the line.
Okay, sounds good. So now let's talk about, hey man, interest rates just dropped. The historical average appreciation rate in Jacksonville is generally 4.6%. So if interest rates drop, we can, reasonably believe or have a hypothesis that prices would go up 5.3%, not too much more, just a little bit of extra juice because the interest rates dropped. And that would mean your home price appreciates by $12,000, 720. Same refinance cost minus 3,600. Your net profits earned, your net worth extra that you have by acting now instead of waiting is $9,120.
Absolutely. And I'll just give a little bit more clarity on the historical home price appreciation rate. It used to be 4.6, but that was before a whole lot of appreciation over the last few years. So the average historical home price appreciation rate for Jacksonville each year is 5%.
Okay.
It's 5%. So, 5.3% is even more believable. And those average years of home price appreciation, very few of them came after interest rates dropped 1% the year before. So yeah, you're pocketing an extra $9,000 by taking action now before interest rates drop, and then, obviously refinancing later to then put yourself into that same spot as anybody else a year later when interest rates are lower than what they are today.
Got it. So now, all right, so that's pretty good. An extra just under $10,000 just because you did it today instead of waiting, right? The whole buy real estate and wait instead of wait to buy. Now, let's say we have a scenario like 2001 and interest rates drop by a point, prices go up 8.9%. Now the home price appreciation that you'd get over the next year is $21,360 minus same refinancing cost of $3,600. Now you just added $17,760 to your net worth just by acting today instead of waiting to refinance later.
Bingo.
That's pretty sweet, man. That's a Honda Civic for my kid.
There you go.
Right.
There you go.
Vincent Barberite says, how much down are JWB lenders requiring on the 30-year fixed right now?
It's not really a matter of requirement. To answer the question directly, the minimum required would be 20% down. But a lot of our JWB clients are putting more than that down, and simply because in order to get positive cash flow, you need to put more than 20% down. You'll need to be somewhere around 35 to maybe 40% down. And that's how we continue to generate positive cash flow, even though interest rates are higher than they used to be back in the day. And even though prices are higher than they used to be back in the day, we just solve that problem by putting a higher percentage down.
Okay, got it. So moral of the story here is if we believe that interest rates are going to drop by 1%, buying today adds, if you think home price appreciation is going to go 2.5%, it adds 2,400 extra net worth to your bottom line. If you think it's going to go right around the historical home price appreciation plus a little bit of bump, it's almost $10,000, 9,120. And if you think it's going to go anywhere close to what it did in 2001, then it is $17,760. But GC, there is the other side of the coin, which is, okay, cool. So this is what I would be locking in right now. What does it look like if I wait to buy? Is it only that I would lose out on this net worth, or is there other stuff? What do you say to that?
There's a whole lot of other stuff too.
Okay.
And I wanted to make sure we shed light on what would be the alternative. How much would you be giving up? Because it's actually more than what I just shared with you there when we start to think about all of the profit centers. So let's do this next scenario here. And let's assume that you waited a year to buy the property. Interest rates dropped, just like we said, 1%. Home prices went up by these three categories, that either 2.5%, 5.3%, or 8.9%. But let's look across all of the profit centers to really see what you're giving up, because it's even more than those staggering numbers that we were just talking about.
Got it. As we know, there's 5 profit centers in rental property investing. There's only 4 here that we're talking about, right? We're talking about cash flow, aka rental income, tax savings, principal pay down, and home price appreciation. So now if you add those, right, like if you add those to that same list, when prices go up by 2.5%, you're also missing out on getting $1,274 in rental income. You're missing out on $1,094 in tax savings. You're missing out on $1,852 in principal pay down and the home price appreciation that we just talked about, which brings us above $10,000. If it goes up 5.3%, which is historical, average plus a little bit of juice, now you're going from having missed out on $9,000. I'm not gonna. Yeah. Oh,
roughly 9,000.
It was roughly 9,000 to actually more stuff here, right? Like you lose rental income of the 1,200 again. The same, I guess the tax savings, rental income, and principal pay down all stay constant. Why is there extra home price appreciation loss here? Or is there?
Well, it's because the home price is appreciated at 5.3% versus the home price is appreciated at 2.5%.
Got it. But if before it's at 5.3%, the net profits the net profit would come down. Oh no, it's this number. Okay, I messed that up. Everybody dismiss that. Don't worry about that. So you lose a home price appreciation of $12,000. You essentially losing net profits of $16,000. And again, if it goes up 8.9%, you're losing out on net profits of $25,000. So now we're not talking about a Honda Civic. We're talking about maybe like a Vita, like a Jetta.
There you go. I mean, sure.
A really nice,
not much of a car person,
like an Accord.
That all sounds great. It all sounds great to me.
Really good safety ratings.
I'm thinking about like 4 trips to Bandon to play golf. That's what I'm thinking.
Yeah. 20. I mean, listen, man, $25,000 is like that is you can put that into private lending. You can do a lot of stuff with that money.
There you go.
Yeah.
There you go.
So, I mean, what do you want to take away here, GC?
Well, so we talk about, is it better to buy or is it better to wait? We can take this from another angle, right? Like, if there are some who believe that home price affordability is such a challenge right now, and there are some who believe that home prices are going to go down. And listen, nobody has a crystal ball. We've been right most times on this show. We clearly believe that interest rates going down will lead to home price appreciation, and especially Jacksonville. There's other things that are going to lead to home price appreciation at some point over the next few years. But you could say to yourself, let's just say that you think the opposite. Home prices would have to go down so significantly in order for this to make sense to wait, right? Or home prices would have to appreciate so much less than historically what has happened after interest rates go down for it to make sense. I mean, for it to make sense to wait. You're starting to get into like, you would have to get into kind of like Great Recession type of events. In order from a numbers perspective for you to come out ahead of waiting. Right. And I don't know, there were a lot of people who felt like the Great Recession was going to happen again, a year and a half ago. We at the show said we did not see that happening. We did not see the crash happening. It's turned out that way, meaning that home prices have actually gone up in Jacksonville year over year. I don't hear anybody talking about how the Great Recession is coming now. So it would, from a dollars and cents perspective, if you are thinking about buying your next property from a dollars and cents perspective, it is a much better bet to take advantage of buying now before interest rates continue to go down, so that you can set yourself up with a new Jetta or Civic
or Accord,
or you can pay for, half a year of college for your kids, or, all those things that are a whole lot more important. I mean, we're talking about $10,000 to $25,000 that you can set yourself up for by making a good decision today versus sitting on the sideline. So so there's a whole population out there that's just waiting for the right time. I think this is a very special moment, and why this is the right time, especially because interest rates are such a big driver of what home prices do.
Yeah, I see this show as the ultimate proof of why the average investor might think to wait for the right time to buy real estate, and then not your average investor understands this old adage of no, you buy real estate and wait. And even though we say this as a blank statement, as a motto, and we believe it overall, because over a long market cycle, over a full market cycle, that's always going to hold true. If we look at the moment right now, the only reason why you would wait would be if you think prices are going to go down.
Mm-hmm.
And what we've seen over the last year is that interest rates threw everything they could. They threw the kitchen sink at home prices, and home prices have stayed level / gone up a little bit.
Mm-hmm.
And now what we are seeing is interest rates are starting to come down, and there's all this data that shows that they're going to continue to go down, which there's all this data to show that prices are going to go up. So, this moment of like, is this the right time? Is it not? Should I wait for this thing? It seems like a resounding no, with a very, very safe, like level of assumptions that you're going to come out ahead somewhere between, $10,000 to $25,000 in net worth in year one of this investment by pulling the trigger right now and getting ahead and locking this in. And that's notwithstanding the idea that Jacksonville downtown is happening, that Jacksonville itself has really, really good metrics of like population growth and rental demand and housing demand, and a ridiculous dearth of supply in this asset class of workforce housing.
Absolutely. And let's talk about the incentive too. So the incentive that JWB is still currently doing is one to help you out with interest rates. And it comes out to about a $5,000 incentive that we are still currently doing. And the only reason that we have done that is because interest rates have been so high. Yeah. So as interest rates come down, I'm sharing with you now that incentive will go away at some point. So you can take advantage of everything we just talked about here, $10,000 to $25,000 of additional profits by buying before interest rates go down, plus, call it another $5,000 roughly of an incentive that JWB is doing. So I really do think it's a special moment. I hope everybody listens and takes advantage.
Yeah, I agree, man. I think this is a really good job by you of illustrating this thing. For me, these are the numbers. This is the rational, right? Like, I think people like to hear stories and like to hear like actual scenarios where it's happening on the street. And I can tell you, if you've been watching the show, I just bought a duplex myself that I'm going to move into one, rent the other one out. This is a duplex that had been on the market for 6-7 months. We got in right as that first drop in interest rates happened. And the moment that we made an offer on it, there was a competing offer and I had to compete, right? So I've told this story before on the show, but what I just found out is that this duplex is owned by a developer that owns 3 duplexes right next door to each other. We actually were looking at all 3. We put an offer on this one, right? And that was the one that we competed with. I think they probably wanted the same thing. It's $675,000. The investor that is listing these things has now listed the other 2 directly next to it. Same exact floor plan, everything, same exact scenario. One is empty, the other one is rented out for $5,000 more already. He has already increased the price of it by 7% because of this activity. So we're already seeing this happen anecdotally myself in what I am doing on my own personal active side of real estate. I think it bears to reason that this idea that prices are going up right now in Jacksonville, and the data will show it in the next, once the data matures, is very real.
Yeah, man, that's such a great example too, because, when we're talking about lost home price appreciation by sitting on the sidelines, if you hadn't made that move to do that, you would have lost $5,000 of home price appreciation in a week, right?
Yeah.
So this is very, very real. Yeah, I think this is one of those moments, we have stuck our necks out there at a few times and said, this is how we see it. It's going to be different than how others see it, but this is the way we see it. And this is one of those moments where I'm telling you, this is the way we see it too.
Yeah.
Where we see home prices going up significantly over the next 3 years. I don't know exactly how it's going to happen, but now that interest rates are dropping and now that people are believing that inflation is under control, there is a time-sensitive urgency to this, because the more that the economy and the investing public believes this, the faster interest rates will drop and the more that the opportunity will not be as great if you wait.
So. To recap what you're saying, when COVID broke out, the immediate reaction by everybody was to believe that home prices were going to drop. You went out there and you showed months of inventory data and you said, COVID's never happened before. This is a completely different thing, but I can tell you this, we believe in this data And if months of inventory are where they are right now, that tells us that in the short term, home prices are going up. And during COVID, home prices shot way up.
Mm-hmm.
At the end of 22, coming into 2023, interest rates started going up. Everybody immediately started thinking, okay, interest rates are going up. They're going to raise them 3-4 more times. Prices are going to go down. You said, hey, we believe in this data that we have. We believe in the perspective we've had over a long time. And even if interest rates go up like they are talking about, we do not believe that prices are going to go down. We think prices will slow down in its appreciation, maybe even flatten out, possibly go a little bit negative, but we do not think that things are going to go down. And what ended up happening is interest rates went way up more than you thought that they would, and prices stayed stable.
Yeah.
And now this is the third time that you're going out there calling the shot. I feel like the first time you were terrified.
Yeah.
The second time you started feeling pretty confident because now you got a track record. This time I don't sense a lot of fear in you at all.
No, I really believe this is going to help people make a lot more money by listening to the data that we have and the perspective that we get to share. So yeah, I'm excited about you all making really good decisions and coming back to the show and saying, hey, Gregg, I remember when you said that this was going to happen in, January of 2024 and it's January of 2025. And you're like, well, listen, I just gained, $17,000 of profit through the profit centers.
Got myself a Honda Civic.
I just got myself a Honda Civic.
Honda Civic. Room, room. Okay, cool. We got a question by Anonymous attendee over here in the chat saying, in the Q&A actually, thank you for putting it in there, saying, why is the table not having price reduction for the property scenario? Can that be added, please? I would assume, Gregg, I'm going to just answer ahead of time, but like, I would think that if you think that the price is going to go down, then go ahead and wait.
Yeah, I think that's great. Yep.
Yeah.
Yep.
If you think the price is going to go down, go ahead and wait. I think we've just beat it up pretty good, telling you why Gregg is so certain that, he does not see prices dropping in the near future.
I think you answered that perfectly.
Okay. Well, I try to do that because you'll try to be too nice.
There we go. We'll make a great team.
Right. Mike Foster's got a question. I might try this after today's show, but have you analyzed an approximate crossing point where waiting for a lower interest rate is worth a certain percent of the rising cost of a home purchase?
All right, let me look over here.
What would be the crossing point of when interest rate goes down, price goes up, but you're still ahead by waiting? I would assume it would mean a higher, like a bigger drop than the numbers that you're putting out there, and a lower home price appreciation than the numbers you're putting out there at some point, if you really want to hit it with the bullseye with a dart.
Yeah, yes, we could get a little bit more specific here. What I would think is a more macro crossing point, right? So let's assume that the net rental income, tax savings, and principal pay down are what's that, about $4,000 of costs, right? So for you to make a good decision to wait, you would have to have home prices lose more than $4,000 for this to make sense over the course of the next year.
Yeah.
So
that makes sense.
Right. Like,
yeah.
So I think that's really the break even. If you believe home prices are going to drop more than $4,000 on a $240,000 property,
which is
less than 1%. So, or no, less than 2%. So, right. So if you think home prices are going to go down 2% or more next year, then it probably makes sense to wait.
Yeah.
Yeah.
But yeah, Mike Foster, if you come up with that calculation, come on the show. Let's talk about it, buddy. Sure. Yeah, I'd love, or share it in the Facebook group, man. I think that'd be very, very interesting. Chris Gonzaga from an illustrious place,
clearly,
the Hudson Valley. Are condo prices outpacing houses in Jacksonville? Here in New York, condo prices are way up compared to houses.
When we say outpacing, condo prices and townhomes will typically sell at a lower cost, of course, to single family real estate. I haven't looked at the growth rate of condos or townhomes and compared to single family homes. So I don't really have that data. What tends to happen is when home prices hit their low point, condos and townhouses tend to grow a lot faster than single family properties because they are lower cost and allows people to buy more. So I don't know. You know what? I can probably look into that for us for a future show as far as seeing what the growth rate is between condos and single family real estate.
Sounds good, buddy. GC, I feel like I gave you a pretty challenging nut to crack here.
Yeah.
And I feel like you decimated that nut.
Thank you, brother. I appreciate it, man.
Yeah.
It really came from you, and it came from one of the questions from one of our friends in the audience. They were asking questions specifically to this. So this all comes from you guys. It makes my job, Pablo's job, so much easier when you have great questions. So we want you to know how much we love those questions. We really, really appreciate it. And when you have good things that you're wondering, fire it to us, and it'll be the next topic.
He will stay up to midnight, 2 o'clock, 3 o'clock to solve this thing for you and present this. I know from personal experience. And another reason why he does it is because every time that we answer a question that's been asked on the show, 70 plus people show up. That is good feedback for us. We want people here. So if you have a question and you give it to us, we're going to put the work in to answer it in a way that is clear and is entertaining.
Absolutely, brother.
So speaking of which, this Thursday, we got the guy.
Our resident.
We got the resident.
The Hall of Fame. Are we gonna get him the jacket?
I think we should get him a jacket.
I don't know if we can do it.
Is he coming to the summit?
I don't know. We have to ask him.
We should get him a jacket. We should get him. Anyway, Paul Shively's coming back. We're doing something a little bit different here, folks. We're gonna flip it.
Ooh.
We're gonna flip it, right? Because Paul's been on here a bunch of times. He brings his audience on here. Whenever we got Fortune Builders, Paul's showing up in the house. 150 people show up to the show because he's so cool and everything. And this time around, Paul is going to interview Gregg about getting in the path of progress, right? All the stuff that we've been talking about, from real estate going up because downtown is popping. We're going to put Paul Shively's actual real estate expert brain instead of my noble fool brain. And we're going to put Gregg to the test with Paul coming in with hard-hitting questions to Gregg about how much does downtown really matter? Is this really path of progress thing? How big of an opportunity is this thing? And Gregg is going to, be on the hot seat for once in his life.
Oh yeah, man.
Well, no more lollipops from me.
No more lollipops. I mean, Paul manages over $1 billion in real estate. So he has really good questions to ask. He's in charge of a lot of money and putting in different places, and he's invested in all over the country. So on this show, you get the lens from JWB, which we are all in on Jacksonville. It will be really great to have his insight and to have your questions, the ones you've been thinking and maybe the ones that were kind of in your brain somewhere. I know Paul's going to ask those questions, and we're all going to be the better for it.
Sounds good. Billy Green says he'd love to see a show about JWB doing acquisitions. Guess what, Billy Green? We're going to do it. Margaret Smith, Jeopardy Queen, is asking, let's just clarify whether that investment of $240K includes closing costs, JWB fees, etc. I'm playing with figures here, trying to establish bottom line, how many bucks I need to play this game at a 20 to 40% down payment.
Okay, so the ultimate question here is how much is required, including down payment and closing costs, to purchase a JWB property right now? Somewhere around maybe 75 at the very low end, and more often somewhere around $100,000 to buy one property. And that's assuming that we're putting somewhere around 35 to 40% down. If we did want to put less than that down, we can. But again, cash flow positive typically is the goal for our clients. So you really need to put somewhere around 75 to 100 down in order to be able to be cash flow positive.
Yeah, got it. And again, she's talking about these assumptions we made of buying a $240,000 property. All these numbers hold true based on what she's talking about. It includes closing costs. It includes JWB stuff.
Absolutely.
All that good stuff. It includes the incentive that JWB is offering that buys down points.
Does not include the incentive that JWB is offering.
Okay.
Yeah.
Okay.
So, well, it doesn't include that when we're talking about net profits. I guess it does include that in interest rates and things like that. So,
okay.
Some of it does, some of it doesn't. It's only better than the numbers that I put here. It's way conservative.
Yeah, that's right. Gregg tends to underpromise, overdeliver. So take that. I didn't want to say to the bank because I figured that puts you in trouble with any kind of declaration I can make here. But anyways,
I think you can say take that to the bank.
Take that to the bank, baby. Great show today, man.
Yeah, man, this is great.
Really want to thank the community. 70 people plus showing up today, Tuesday, middle of the day, taking time to be part of the conversation, to help to talk to each other in the chat, to give us the questions that we need to make it better, to give us the questions we need to make good shows for other people to show up. This doesn't happen without you. We can't wait to meet you at the JWB Summit coming up in February 16, 17. Mark your calendars. Go to jwbsummit.com. Use the promo code that Gregg didn't end up figuring out here.
Let's go with NYAI 99 or NYAI S99.
I think it's NYAI 99. Pop that in there. You get in for $99 and you get to meet our parents. You got to meet each other.
There we go.
And you're probably going to meet some highfalutin folks here in the Jacksonville community as well. Spoiler alert, because they're coming on this tour. Don Werner said that he was going to swing by, maybe. Said it on a past show. It's the only reason why I'm repeating it.
Yeah.
And it's going to be a great time. So hope to see you there. Hope to see you Thursday. Make sure that if you're here, you're going to show up. You know, do what you always do. Be hospitable to the Fortune Builders folks. I feel like we make a nice partnership here. They're similar people like us. So show up in droves. And from now till then, what do you think they should do, GC?
Don't be average.
See you on Thursday.